Absolutely. So I think we'll probably look at it maybe in two cases. I think interest rates, everyone seems to be focusing first and foremost on the US, given that that is the higher interest rate. I think we'd start to see signs that that is feeding through into subdued housing activity. And I think going forward, a lot of the narrative will surround Powell and how many interest rate hikes he does next year. But if that rhetoric could soften maybe from 4 to 3, then I think that will definitely be taken well by asset markets. And as we look domestically, I still think there will be some way for interest rates to rise before it pressurises the economy too much. I think the reasons in no small part are the mortgage market is largely fixed these days, and we can look at the average interest rate within the mortgage market being at about 2.5%. And therefore, given the ongoing competition in the mortgage market, I think we would observe that there won't be a huge amount of pressure placed on the mortgage market really for the next 75 basis points of interest rate rises. It has to be with an increased margin of safety. So maybe if we look at trade wars, and the obvious knock-on will be global growth, I think therefore you need to concentrate on companies that you could convincingly argue maybe are the cheapest they've been for at least a decade, and therefore that includes periods such as the global financial crisis. So you really look at long-run valuation techniques such as price to sales, price to book, rather than necessarily concentrating on near-term earnings. With regards to Brexit, again, I think you need to demand a greater margin of safety, and from that I think you therefore need to look towards asset values, replacement costs, and hopefully express your positions below those levels, whereby, as I say, I think if you can expose yourself there, you're in a situation whereby the margin of safety is good. And then often I think if we are entering tougher economic times, I think the margin of safety needs to be ever greater on the balance sheet. And I therefore think investors should very definitely tilt their portfolios towards net cash businesses and strongly financed businesses, rather than maybe taking the risk of too much financial leverage. If we look at a couple of measures, what we'll look at, I think, is firstly, if we look at it on PE, I'm conscious that some might question the earnings, but if we do look at it on PE, we'd sort of observe that probably the UK relative to the FTSE world is trading in that sort of bottom 10% valuation range relative to history. And then also if we look at it from a dividend yield perspective, and we look at the yield gap of equities versus bonds, this sort of 2.5% yield pickup that you're getting in equities versus bonds, you've got to go back really to World War II to find that level of pickup. So I think that does talk to two, quite meaningful value yardsticks that I think exist today, but clearly these are a function of Brexit, so it's a question of whether fear has pervaded into valuation, and I think to some extent you could argue it has. I think firstly I would observe there are international businesses that look very unusually cheap relative to their international peers. So from that perspective we want to tilt ourselves to those global facing businesses that have similar businesses that we can benchmark valuation overseas and look unusually cheap. And as I say, it is possible to find businesses trading at about a 30% discount relative to overseas peers. I think the second thing with regards to trade wars, it's very definitely certain areas that have been affected quite dramatically with regards to some cyclicals, maybe some overseas banking shares. And in those situations, we feel if we line up both valuation and also capital strength, I think you can convincingly argue in a few situations that these companies are the cheapest that they've been, for long, long periods of time. And then finally, domestically, I think it's been well documented how much sort of, concern I think there is about the domestic outlook. And I think where you can find domestic shares that have strong balance sheets as defined by net cash, trading below book, trading below replacement cost, I think those are things that you will be well rewarded in the short to medium term as well.